In this video, we will discuss some simple and effective tax-saving tips for individuals in India. With the tax season around the corner, it's important to know how you can save money on your taxes and keep more of your hard-earned income. We will cover some popular tax-saving options that you can take advantage of to reduce your tax liability. Hello and welcome to our video on tax-saving tips in India. With the tax season just around the corner, it's important to plan your finances and take advantage of the various tax-saving options available to you. By doing so, you can not only save money on your taxes but also secure your financial future. Section 1. Investments that qualify for tax deductions. We will discuss the various investment options that can help you save taxes, such as PPF, ULS, NSC, and ULIPs. Section 2. Claiming deductions for expenses. We will explain how you can claim deductions for expenses such as medical bills, education expenses, and donations. Section 3. Tax-saving tips for salaried individuals. We will discuss how salaried individuals can take advantage of the tax-saving options available to them, such as LTA, HRA, and EP. So let's get started. Section 1. Investment that qualifies for tax deduction in India. There are several investments that qualify for tax deductions in India under Section 80C of the Income Tax Act. Here are some of the most popular ones. Public Provident Fund, PPF. PPF is a long-term savings scheme that offers attractive tax-free interest rates and tax benefits. The contributions made to PPF are eligible for tax deductions under Section 80C. Equity-linked savings scheme, ULS. ULS is a type of mutual fund that invests primarily in equity and equity-related instruments. Investments made in ULS are eligible for tax deductions under Section 80C, up to a maximum of Rs.1.5 lakh per annum. National Savings Certificate, NSC. NSC is a fixed income investment scheme that is issued by the Government of India. Investments made in NSC are eligible for tax deductions under Section 80C. Unit-linked insurance plan, ULIP. ULIP is a life insurance policy that also provides investment options. The premium paid towards ULIP is eligible for tax deductions under Section 80C. Tax-saving fixed deposits. Banks offer special fixed deposit schemes that are designed for tax-saving purposes. The investments made in these fixed deposits are eligible for tax deductions under Section 80C. Sukanya Samriddhi Yojana, C is a savings scheme that is designed for the education and marriage of girl children. The investments made in C are eligible for tax deductions under Section 80C. It's important to note that the maximum tax deduction limit under Section 80C is Rs.1.5 lakh per annum. Therefore, it's advisable to choose the investments wisely and plan your finances in advance to maximize the tax-saving benefits. Section 2. Claiming tax deduction for expenses in India. Taxpayers can claim tax deductions for certain expenses incurred during the financial year while filing their income tax returns. Some of the common expenses that are eligible for tax deductions in India include investments. Taxpayers can claim tax deductions for investments made in various financial instruments such as Public Provident Fund, PPF, National Savings Certificate, NSC, Equity-Linked Savings Scheme, ULS, and Unit-Linked Insurance Plan, ULIP. Insurance premiums. Premiums paid towards life insurance policies, health insurance policies, and critical illness insurance policies are eligible for tax deductions. Education expenses. Taxpayers can claim deductions for tuition fees paid for their children's education. Home loan interest. Taxpayers can claim tax deductions on the interest paid on their home loan. Medical expenses. Taxpayers can claim deductions for medical expenses incurred for themselves or their dependents. Charitable donations. Donations made to eligible charities and nonprofit organizations are eligible for tax deductions. It is important to keep proper records and documentation of all eligible expenses to claim tax deductions accurately. Taxpayers can claim deductions by submitting relevant proofs and documents while filing their income tax returns. Again, it is recommended to consult with a tax professional for individualized advice on claiming tax deductions in India. Section 3 Tax Saving Tips for Salaried Individuals in India. As a salaried individual in India, there are several tax-saving tips that you can consider to reduce your tax liability. Here are some of the most common and effective tax-saving tips. Invest in a tax-saving instrument. There are several tax-saving instruments available in India, such as Public Provident Fund, PPF, National Pension System, NPS, Equity Linked Savings Scheme, ULS, etc. You can invest in these instruments to reduce your tax liability under Section 80C of the Income Tax Act. Claim deductions for medical expenses. You can claim deductions for medical expenses incurred for yourself and your family members under Section 80D of the Income Tax Act. Claim deductions for interest on housing loan. If you have taken a housing loan for purchasing or constructing a house, you can claim deductions for the interest paid on the loan under Section 24 of the Income Tax Act. Claim deductions for education loan. You can claim deductions for the interest paid on an education loan taken for yourself, your spouse, or your children under Section 80E of the Income Tax Act. Claim deductions for donations. You can claim deductions for donations made to charitable organizations under Section 80 grams of the Income Tax Act. Opt for the new tax regime. If you don't want to claim deductions under Section 80C, 80D, and other sections, you can opt for the new tax regime introduced in 2020, which offers lower tax rates but doesn't allow for most deductions. Submit investment proofs to your employer. Make sure to submit investment proofs such as receipts of insurance premiums, PPF contributions, ULS investments, etc. to your employer before the deadline so that they can consider them while calculating your tax liability. Plan your taxes early. Start planning your taxes early in the financial year and make investments accordingly to save on taxes. Don't wait until the last moment to invest in tax-saving instruments. It is always advisable to consult a tax expert or a financial advisor to understand the best tax-saving strategies based on your financial goals and tax liability. Conclusion. In conclusion, by following these simple tax-saving tips, you can reduce your tax liability and keep more of your hard-earned income.